In this video, I'm going to show you how to cut the biggest bill of them all, your mortgage. Spiraling energy, food and petrol prices amid warnings of a recession mean most households will be thinking about how to keep other costs as low as possible. So what should homeowners do about their biggest monthly outgoing, their mortgage? In March 2020, all banks were told by the government they needed to offer any customers who asked for one a break on repayments of any loans, credit cards and mortgages of up to 6 months to help alleviate some of the financial pressures people faced during lockdown. While this scheme came to an end last year, you can still contact your mortgage lender and ask for a payment holiday if you are concerned about how to meet monthly bills. Whether it is granted or not is now at the lender's discretion. If they do decide to offer you a break, it will typically be for about 6 to 12 months. Please be advised that if you are ever struggling with repayments, always get in touch with your lender at the earliest opportunity. This is because they are required to exercise forbearance and to do whatever they can to help you through a difficult financial period. However, there are major downsides to taking a payment holiday, so do treat it as a last resort. That's because even if a bank approves your application for a short break, brokers warn that it will show on your credit file that you have not met monthly repayments. This could damage your ability to remortgage or take out other types of loans for years to come. Furthermore, banks will also only be offering a pause on repayments, not writing them off, which means once the holiday is over, your monthly bill will be higher than it was before to make up for repayments and interest the bank has missed. A better option for the health of your credit file is to extend the length of your mortgage term, which will bring down monthly payments by spreading what you owe over a longer period. For example, let's take a property that cost £450,000 with a mortgage of £200,000 and 15 years left to go. On an interest rate of 2% for a 5-year fixed rate loan, you could reduce your monthly repayments by £130, taking it from £1,287 a month to £1,157 by adding 2 years, or £275, taking it from £1,287 to £1,012 a month by adding 5 years. The catch is, however, that you'll pay more interest in the long run, and this can be thousands of pounds based on just 2 to 3 years of added interest. Although the average term for first-time buyers is extending to at least 30 years, as prices on mortgages and homes have increased and deposits are even more stretched, as younger borrowers have more time to increase their earning potential and move to a different deal in the future. Banks may be more reluctant to extend your term if you are in later life and may question whether it will put you in a worse position in retirement. You should also consider if you are introducing more volatility, because the longer you have your mortgage to repay, the more you are exposed to rising interest rates. Another popular option during the pandemic was to switch styles of loan, from a mortgage where you repay both the capital and interest of your home to an interest-only deal where you clear just the interest that accrues. This will cut your monthly repayments dramatically. On the same aforementioned £450,000 property, with a £200,000 mortgage outstanding and a 2% interest rate, you would cut your monthly bill by £953 a month, taking it from £1,287 to £334 a month by stopping capital repayment. Again, most lenders will entertain this, but they will take into account how much you earn. Some have strict lower limits of income of between £50,000 and £100,000, and if this is a joint income, the minimum threshold will be higher. You will also need to have a plan in place for what you're going to do when the interest-only period comes to an end, with most interest-only borrowers expecting to sell their property and downsize to repay the capital sum left over. If this isn't for you, you could decide to overpay later down the line and make up the difference more gradually, or shift onto an interest-only loan for a short period while needed and then repay in a lump sum before the term ends. And finally, consider overpaying. Whilst it may feel counterintuitive, while the cost of living is becoming so high, to consider throwing even more money at your mortgage than you already are. But if you have a healthy amount of emergency cash savings and are lucky enough to still be on a fixed rate loan from before the base rate started to rise, and with a very competitive interest rate, you could save a lot of money over the long term by overpaying now. That's because whilst reducing the balance directly cuts the amount of interest you pay, it also helps to build up the equity in the property, which could make more, cheaper options available for you when you come to refinance. Consistently overpaying can ultimately mean the mortgage is repaid years earlier. Pretty much all mortgages allow some level of overpayment, usually about 10% if you're on a fixed rate deal. But do read the terms and conditions so that you do not accidentally incur charges. And do remember that it's always important to pay off the most expensive debt first, so any credit card balances incurring interest or more expensive unsecured loans should take priority. I hope you found this video helpful. If you did, please do give it a like and consider subscribing. Why not share this video with someone else you think may benefit from it? And if you have any questions or comments, leave them for me below and I'll get back to you as soon as possible. Thanks again for watching, and I'll see you in the next one.